Alright, let's talk about IREN stock. I like this stock, I will talk about exactly why. So thank you to the Discord channel here for recommending this company. This is a managed service provider. Love those. We see them everywhere today. They are huge in the Nordics. This company operates in Canada, for example, a bit in Texas. We see it later on in the quarterly earnings report. We're gonna take a quick look at that. But before we do that, I will talk a bit about the balance sheet as well, and also why it's important to look at the balance sheet for a company like this. So they're a managed service provider. They buy data center hardware, software, hire the staff to manage it, have the salespeople to call out to IT managers and offering them, hey, we can be your colo, basically. We can be the place where you run compute, the place where you have your backup, whatever it might be. They can manage it for the customer. And this has an extreme value proposition from the viewpoint of the customer. The customer does not have to buy his own hardware, in this case. That usually requires the approval of the investment board in the company. They have a limited amount of budget. But with this consumption model that companies like IREN here offers, they can just buy it as a service and they do not need to involve the investment board. Just fantastic for IT managers with a tight budget. Sure, it will be 300 to 500% more expensive over the long run, but that is where the profit margin for MSPs come in. It's an extremely profitable business. It's just such a nice concept. I love managed service providers. And this is why we are looking at the balance sheet. You see machinery, furniture, equipment. So this is in thousands of dollars. So this means that as of here, 2025, this is annualized. Could do quarterly as well. That makes more sense. Excellent. It did not take away this extra detail here. But we can see that 1.2 billion here in data center hardware, basically, and software licenses as well, where they have extra runtime left. This could be, for example, the hypervisor, whether they're running VMware, Proxmox, Nutanix, whatever it might be. The Dell PowerEdge R770 servers that we see in their quarterly earnings report will also fall under here. Machinery, furniture, equipment. So just a massive amount of hardware that's on the balance sheet. And are they depreciating this correctly? Because this hardware has a certain run rate. The disks in the server only last so long. Eventually you need to replace all of them, and it's an old model, and it's just you run it into the ground basically. How long can it last? 5 years, 6 years, 7 years? Most people, for servers for example, they buy 3-year support up front and then run it for perhaps that time. They could run it a bit longer depending on the workloads that they have on it, up to 5 year in that case. For storage, they could run it a bit longer, but also as they continue to hold this hardware. After 5 years, we tend to see a bit of a hockey stick effect, where renewing support on those from vendors will be very expensive. So it's a good practice to write off the value of that data center hardware over 5 years. If we just look at standard practices from most vendors, such as, for example, Dell, HPE, companies like this. So I think that depreciation in this case in relationship to total value is very reasonable, and this is showing up as a paper loss on the income statement as well. And I think that they are not under depreciating it to just get profitability today. That's not the picture that I get from looking at these numbers. I think that they are doing it fairly, and I don't think that we have anything to worry about in this case. We also need to look at funding, of course, how leveraged the company is. We can see total assets here, 4.2 billion in this case. And we can see if we look at total debt in this case, not even a billion fully, so not that leveraged. And they are building their own data center locations. They are not renting from companies such as, for example, Iron Mountain in this case. So I think that they have a strong balance sheet. I think that they are not under depreciating their data center assets. I think that the pace that I'm seeing from looking at the balance sheet is fair. So no worries there. As I said in the opening of the video, I like this stock. Let's zoom in here. Let's zoom in a little bit for you guys. There we have it. The Dell PowerEdge R770. I used to sell these bad boys back in the day. R just means that it's a racked server. We have T servers, not transformers, but tower servers, you know, and then bladed servers as well. But in this case, of course, we rack them and we stack them. Beautiful. You can see some of the highlights that they get these AI cloud contracts. Some of the very, very large public clouds. They can't keep up with demand always, and also having local data centers closer to the businesses that are renting from them, whatever business it might be, gives lower latency because you can't outcompete the wide area network. If you have to send a lot of data over that, it's going to slow down your application. So having a service provider, in this case closer, just good stuff, and partnering with Microsoft to be able to provide this closeness just makes sense. Strong results, growth outlook looking very good as well. So we're talking about annualized run rate, ARR. That's what I talked about in the beginning of the video, that they're selling it as a service. They're billing by use. Very good sales pitch for customers. They love this. Here we just see more of these beautiful servers being stacked. Very nice. I talked about location as well. You can see some here in Texas, and we also can see here in Mackenzie, BC, Prince George, BC, the geographical location. There are plenty of opportunities for a lot of these companies, like IREN here in this case. We can see, for example, CoreWeave in Sweden. We can see Nebius as well. There's just huge opportunity for managed service providers, and I see small new ones spring up locally in smaller towns in Sweden as well. They are profitable. They are filling a demand in the market. And this is the geography as of now. So we see here up in Canada and in Texas here in America, the Sweetwater site. Of course, the annualized run rate expected to ramp. Yes, they buy more demand, they sell that, and as they get better relationship with vendors, such as, for example, Dell in this case. Dell could potentially just put out 1,000 servers, 100 servers, whatever, just free of charge in the beginning, and then as they're being used by customers, as the capacity is being rented, then Dell will charge them. That could be how one of these deals look. Or they could just negotiate up front, buy a lot of capacity, and get very cheap prices, because they have done negotiation a lot. Just buy it straight up capex if they have the cash to splurge. But yeah, they will continue to buy more capacity, and they will continue to rent it out because the demand is definitely there. And that's the beautiful thing about data centers as well, compared to other companies. Data only grows. Applications, you can see the graphics in your video games, the graphics in the app where you log into your gym, or where you pay your parking, or whatever it might be. It becomes sharper, it becomes faster, it just puts more demand on the data center, and it tracks more of what you do. It tracks your location in the background, so it has some object data, some metadata, and all of these things are being saved, so it puts more demand on the data center. Data grows, they capture more data, and the demand for compute increases as well, especially with this AI workloads, with AI training. The training part, extremely expensive indeed. I've seen some of those projects in Sweden when companies have done the training. It's very compute intensive in some cases, and they need the GPU type of hardware to be able to do this properly. It works, the GPU does more sideways if you look at the connections, whereas the traditional processors, they just thread back and forth more, if that makes sense. So GPU can make those connections more seamless. In terms of the data center update, we can see more capacity here in Canada, just continuing to construct liquid cooled data center. Wow, I reacted to this. We don't see this in a lot of businesses in Sweden. This is too advanced. This is very advanced indeed. So they are definitely in the forefront in terms of what they have right now. It will have a long shelf life indeed. Yeah, AI workloads. There's no other explanation. There's no other project I can think of, and I've worked selling hardware for a long time. I can't think of any other project that would require liquid cooling. So definitely AI workloads. Here we have regarding the Childress site, the construction, durable infrastructure engineered for 20+ year asset life. I believe that. Liquid cooling, as I said, it's very advanced. That will be able to cool a lot of future generations of data center hardware. No worries there. This is, even if non-volatile memory express gets more developed and faster, it will still cover that storage need. It's, the high performance GPUs from NVIDIA that need this type of thing today. Backup storage definitely does not need this high level of cooling that they put in today. Liquid cooled data centers, man. Yeah. I wish I could sell to one of these data centers in my day-to-day. That'd be amazing. But I can do the next best thing perhaps and invest in the stock in this case. So more on the Sweetwater hub, and then in terms of the financial update, this is the second part of the presentation that I wanted to share some insight on. We can see that net income, they recently here became profitable, and it looks like this, you flip the switch, you do the groundwork, you put in the capex, the expensive part, you pay up front, and then it continues to bring in more ARR, annualized run rate, and eventually you just flip to profitability. So you have this fight against the clock in terms of funding, in terms of having the money to buy the hardware, buy the software. But then once you have it up and running like this and you have the customers in place, well, you get the positive net income. And companies like this also have a moat, and that moat is that if the company put all the data for their applications in this data center and run from there, then removing that data, doing a migration, as we say in the business, it's very annoying. Amazon used to do this, AWS, they would drive a actual truck to some of the larger data centers. I think they called it a snowball, a snowmobile, and something like this. They had some special branding terms for it, but they would drive an actual truck and just hook it up and transfer the data and then drive that truck to their data center, and then you migrate it over there, and you get a good deal on it when you migrate from your own data center. But then if you want to bring it back on premise for yourself, well, that's a whole nother deal. That's gonna be a lot more expensive in that case, charged by terabyte or gigabyte or whatever pricing they put on it, but it's going to be quite expensive. So they have a bit of a moat in this case when customers put their data on their data centers. It's not easy to bring that back. It requires expertise. It's one of the most annoying processes for system admins. They absolutely hate data migration. You have to do it from time to time in your own data centers as well if you decommission old software and build a new cluster. This is a moat, is what I want to say for IREN and for similar companies in this case. Of course, a highlight with the Microsoft contract, it has to be mentioned. It is fantastic for the company in this case, getting some prepayment and good margin on this type of project, definitely. I think that's about enough talking about IREN stock. I like this company. I think that they have done depreciation in a sensible manner. I think that they are growing nicely, like one would expect, and I don't see any other way than idiosyncratic risk where it would go wrong for a company like this. And by idiosyncratic risk, I mean that they do something very bad in terms of security, where they can get hacked and all the data get wiped or something like this, and customers sue them and charge them, they go bankrupt based off of that. That's the risk that I see. Very unlikely a company like this with this type of expertise. They have redundancy. They likely have the main storage where they have the data, and then they have a off-site somewhere where they store an extra copy of the data. So if one of the sites gets hit by an earthquake or a plane crash into it or something like this, well, the customers are likely still going to be able to have data. They're not going to experience data loss. With a size like this, it's very, very likely that they have a professional setup. I mean, you never know, but I just wanted to mention that idiosyncratic risk. The CEO goes out and tweets something crazy, and all of the customers are like, whoa, and leave the company. Something just completely left field crazy will have to happen to derail a company like this, in my opinion, and quite fairly priced as well in terms of price to earnings ratio. I think that it's a bit on the higher end, but it will likely be some sustainable growth for this company going forward. Given the business model, given the moat, I think that this is a good company and I like the stock. Alright, that's been it for this video, talking a bit about IREN. And as always, hope you guys make a ton of money, whatever investments you decide to make. Take care now, bye bye.